Fantastic. Once again, good morning, good afternoon, everyone. Very happy that you are you've decided to join us today in this wonderful home buying seminar, virtual seminar. My name is Sergio, and what I do for Citi is I support our community lending applications to help families and individuals transition to homeownership. So this setting, this webinar is a very safe environment for you to ask questions, understand a little bit more about the home buying process in general. You have a great ally of the Achievement Academy through the San Diego Housing Commission that can continue helping your efforts. So whether you are mortgage ready today or mortgage ready in 3 to 6 months from today or mortgage ready in 1 to 2 years from today, you always have the support of the San Diego Housing Commission to help you achieve your financial goals. So with that, I know Juanita mentioned a little bit about my background, but previously to what I do here at Citi, I did work for an organization, a HUD-approved organization, where we would help families create action plans, whether they needed to work on reducing their debts, increasing their savings, improving their credit scores. Oftentimes, it takes a little bit more work, right, in order to achieve your goals. I always relate home buying as to when you're running a marathon, right? So if we wanted to run a marathon, start on in September 1st, you simply wouldn't just sign up and start running, right? You would take the proper steps, right? You would start to prepare. If you're not used to running, right, you would run the first mile, the second, the third, all the way up to that 26.2 miles that a marathon has. But my point to the analogy is that you would have to prepare to be able to achieve that goal, right? Home ownership is no difference. You have to prepare yourself to achieve that goal. So with that, guys, we'll dive right in. If you have questions, you can put them in the chat box. Juanita and I will be monitoring the chat box, and we will allow for time towards the end to have just an open Q&A session. So I may be answering your question as I move along the presentation, and this is going to be very conversational, by the way. There's no quiz or test at the end, but you're welcome to take notes as well. But know that you do have the resources and tools available through the San Diego Housing Commission Achievement Academy to continue your efforts towards home ownership. All right, so with that today, guys, some of our objectives for today is to just in general understand the home buying process, determine how much you can afford. So this is very important because affordability is very crucial in order for you to not just achieve home ownership, but to sustain home ownership. So you really need to grasp your hands around this concept of how much you can afford. Um, we'll talk about some of the mortgage basics and the application process, how that looks like, what are some of the things you can expect. We can talk about some of the loan options available to you as a first-time home buyer, and we'll talk about what a pre-approval has and what that entails. And we'll also talk about some of the special programs available, not just through Citi, but some of the local down payment assistance programs that are available through the San Diego Housing Commission. So in general, guys, the home buying process, in general, right, this is kind of like a bird's eye view of what you can expect. Now, what we're going to cover in about the next few minutes, right, it's not going to touch upon every single aspect of home buying. So I just want to prepare yourself that although this is a general overview, everyone always has a slightly different path towards home ownership, right? So, but we could we could identify some of those common denominators that will make you a lot more comfortable, right? Gain more confidence so that you can, achieve this great goal, right? So the steps towards your home search, right? It's always good to do your research. Always good to do your research offhand, such as this type of webinar, right? Where you're in a safe environment. There is no sales approach. At the end of the webinar, you're not going to sign on to a monthly subscription. You're not going to be asked to write a check, right? This is truly educational. So the more research you do through your local housing organizations, they can provide you local housing market information as well, and also resources for real estate professionals that can also guide you through the process, right? So once you do your research, you can begin to discuss some of those options that will take you to purchasing your first home. Lending options, financing options, you would typically discuss with a housing counselor or a mortgage representative. So because most of us, when we purchase our first home, we're going to require some sort of financing, right? It's really important for us to know what options we have. Those options that we have will be specific related to our financial position. So although you may come across other friends and family that may have similar financial backgrounds, it's always different. Every person, every applicant has slightly different variations of income, of credit scores, of debt, of history, right, of savings. So that will kind of provide you a different pathway, and along the way, you'll know what different options you will have. So we'll talk a little bit more about that as well. Also, obtaining a pre-approval, right? Obtaining a pre-approval to gain that leverage of negotiating with sellers. So what a pre-approval is, and we'll talk about that in just the next slide or so, but a pre-approval is like your golden ticket. If you recall that movie Willy Wonka, right, and its golden ticket, it's because that pre-approval will have not just your affordability, but your purchasing muscle, right? You're gonna know exactly how much of a monthly payment you can afford and what that translates to your purchasing muscle. Sorry, there's an ambulance passing by. Okay, so once you have that pre-approval, you typically would work with a buyer's agent. A buyer's agent is a real estate professional that will work on behalf of you, the person buying the home. So typically, a real estate agent can function as a buyer's agent, right? Helping the person buying the home to search for the properties, to look at different communities, to look after the best interest of the buyer. You also have agents, which basically can be the same agent, looking out after the best interests of the seller. So that's a seller's agent, right? That's the agent that's representing the seller. So you as a buyer, you can have your very own agent, and they would look out for your best interests. They will help you find your home, submit an offer, which in this current market, it's pretty competitive. Help you negotiate and sign the sales contract, explain the sales contract, because a sales contract is the word kind of says it, right? It's a contract. So there's several steps that need to happen. There's what's called contingencies that need to be released. So for instance, from step 1 to step 2, you can't really jump those steps. You have to go through those contingencies. So that's why having an agent can guide you along the way. Also, during this process, you would complete your mortgage application, which once again, we'll talk about that in a few minutes. Have your home inspected. If there's things that need to be repaired, you and the seller will go back to negotiate how those repairs will be made. Have a final walkthrough, closing that mortgage, of course, and then moving to that wonderful new home, that space that you will call home. So once again, bird's eye view, guys, of this process. Like I said, we can technically have just a workshop on itself on this home buying process, but we'll move right along. So I talked a little bit about a pre-approval, right? A pre-approval is once again, you can relate this to that golden ticket. It's a letter that's provided by either the mortgage broker, the lender, the bank, the lending institution, the loan officer, that has three specific things. It verifies your income, either through pay stubs or tax returns. It verifies your assets through bank statements, and it verifies your credit. They do pull a hard pull credit report. With those three things, a mortgage professional can assess your affordability, how much you can afford every month, and your purchasing capacity. They can also determine if you may be eligible for specialized down payment assistance programs. A pre-qualification is simply an estimate. A pre-qualification, there are no verifications involved. In fact, a pre-qualification, you can do that pretty much on your own with an Excel sheet. Now, I'm not downplaying the pre-qualification piece, but a pre-approval carries a lot more weight, because it's actually a written commitment letter from a lending institution with a specific amount. Real estate agents will require a pre-approval letter for them to submit an offer. A pre-qualification, once again, this is just simply an estimate. It gauges where you're at, more or less, right? It's like a ballpark figure, but it does not have any verifications. So know what you can buy, right? So before you look for a home, affordability, once again, I can't stress enough the importance of knowing how much you can afford. And why this is so important is because this kind of sets up the stage for you to be a successful homeowner. It doesn't help you to perhaps jump into a situation where that mortgage payment will absorb more than what you're used to paying for your housing, because it's really putting yourself in a situation where you may fail financially. So once again, affordability is crucial in this process, because you want to wrap your hands around making sure that the housing payment, and we'll talk about your housing payment in just a minute, is something you can pay every month consistently, along with your other obligations. So affordability is extremely important. A few years ago, believe it or not, income wasn't verified in mortgage loan applications. In certain mortgage loan applications, your income wasn't verified. So without verifying your income, truly, the affordability factor wasn't there because the income wasn't verified. So if someone was just putting in a mortgage loan application an income amount just to qualify, once they were in their home and once they saw their mortgage payment, that was something that was not affordable to them. So it's really important, once again, affordability. Determine how much cash you have for down payment. Although there are great programs out there, and we'll touch on some of those programs, you still have to put yourself in that position. You may be eligible for these programs, but you still have to put yourself in that position. Some of these programs, some of these down payment assistance programs require skin in the game. So although you may be eligible for a down payment assistance program, you have to come in with a certain amount of your own funds. So, well, like I said, we'll touch on that in just a second. You definitely want to continue with your budget, your income and expenses, knowing exactly, your monthly income and expenses. Just like now, hopefully most of you, if I go around the room and by a show of hands, right, who has a monthly budget and who's following a monthly budget, right? That's important. That's extremely important. Even once you become a homeowner, that's even more important. Exactly, assessing yourself, right? Knowing that you have a firm grasp, knowing exactly how much you pay on each of your household expenses, on your obligations. It's important that you continue to wrap your hands around that. Estimate your monthly mortgage payment. So why that is so important is you can actually pretend you are making a mortgage payment today. What I mean by that is if your current rent payment is $1,500 and you want to pretend that you have a mortgage payment of $1,800, right? Just to kind of feel or test drive what a mortgage payment would feel like, then why don't you try that out for the next 3 months? Obviously, you're not going to pay the extra $300 to your landlord, but put that money aside. If you find yourself that you can consistently make that higher housing payment, then you're on the right track. However, if by the 10th of the month, you're having to grab that extra $300 because you need it for other household expenses, then that's where you kind of want to go back to make sure that your budget is under control, right? And of course, determining the type of property you may be interested in. A single family residence is a one unit property. It's either a condo, condominium, or a separate home, right? A multifamily residence, 2 to 4 units is slightly different. Most down payment assistance programs do not lend to multifamily residents. A planned unit development is just a planned community. Newer communities have like a master plan community, and a condominium or cooperative. Well, in California, we have condominiums. Co-ops are more like in the East Coast. Condominiums, right? You buy the space, the unit inside the space of the unit, that's yours, but the structure is shared among every homeowner in that specific building. So knowing that, once again, just depending on the type of property that you'll have access to. So I'll just skim through this really quick, guys, for the sake of time. Closing costs, know that when you buy a home, there are some fees that you have to prepare for. Although there are specialized programs that can assist you to subsidize some of these fees, know that there is a cost to obtain a mortgage. You will pay an application fee, home inspection fees, appraisal fees, right? The lending institution wants to make sure that what you're buying has and meets today's value. There's a credit report fee, discount points based on the loan application or based on lowering that interest rate that you may be obtaining. So these type of conversations, you will have a lot more clear direction once you are in the process of applying for a mortgage. A loan estimate is typically provided as part of your disclosure package, which itemizes every single line item of where those closing costs fees are going to. So it's not until you're actually applying when you'll have a lot more detailed information about closing costs. Here, we just want to make sure you understand there are fees involved and that essentially you would have to prepare. Depending on where you're buying, there might be some legal fees, title search charges, recording and transfer fees, right? Similar to when you buy a car, right? We have to pay DMV transfer fees. Well, when you buy a house, there's also these types of fees, right? Escrow impounds refers to the property taxes and homeowners insurance of the home, which I'll talk about in just a second. Settlement fees. There is a third neutral party that provides the assistance between the seller and the buyers. It's called an escrow company. So there are some fees that you will share with the seller when you're buying a home. But just in general, just know that fees are involved in this transaction and that there are some programs that can help to pay some of these fees. Also, your negotiation of a property, the seller can put some money towards your closing costs as well. So that would be more of a different type of discussion. But and just know that there are fees involved when you apply for a mortgage loan. So these are like the main buckets that a lender looks at to consider a mortgage loan application, right? So essentially, you would have to make sure that these buckets are met so that you would have an approved mortgage loan application. So in no particular order, but we'll start from the left to right. Assets, right? So I mentioned earlier, you have to have a little bit of reserves, a little bit of savings in this process. There are some exceptions out there where there's a couple of programs that do not require absolutely no money from the borrowers. Those programs are very few, far and in between. But if you're buying a home, even if you're using a program that will finance 100% of the purchase price, but when you're buying a home, there's still fees associated with, say, the moving cost, with some minor home repairs that you might be making. So just know that you are, you're not buying a cell phone, you're buying a home. So know that there has to be a little bit of reserves there to assist you, not just for the down payment. As you can see, there's closing costs involved, but some of the external factors as well. Property appraisal. The appraisal is to make sure that what you're buying today meets the value of what you're buying. So an appraisal looks at the value today. It's a snapshot of today. Why is that so important? Is because oftentimes people may relate an appraisal as to, well, the property was worth X amount 2 years ago, or the property can be worth X amount in 2 years. No, you're buying the property today. So whatever you're buying, whatever that purchase price is, that value has to come in, right? And that's the appraisal. If the appraisal comes in less, potentially the bank or the lender could say, I'm only going to lend you up to the appraised value. If the appraisal comes in higher than the purchase price, then that's okay, but the lender or the bank is only going to lend you up to the lower of either the purchase price or the appraisal. What's important here is that the appraisal has to be, or has to meet or be above the purchase price. If it's below, then you might have some negotiation to do. So just know that that's part of the mortgage financing. Credit history, we'll talk a little bit more about credit in just the next couple of slides. So credit is part of the process, not just your score, but the content. So I'll jump over that because I'll talk about that in just a second. Employment and income history. I said a couple minutes ago, right? A few years ago, certain mortgage options did not verify income. Nowadays, income is king because that determines our affordability. So any lender will verify your employment and will verify your income history. So this is your pay stubs, your taxes, your W-2s, and they will contact your employer to make sure that this person, the applicant, is employed. So this is very important because out of your income comes your affordability. And debts. Why debts is important is that your monthly budget will be able to manage your debts. The lesser the debts, the better position you're in. The higher the debts, that may be looked at as slightly a riskier position. So this could be a situation where you can meet all 4 buckets, but you're still maybe carrying a little bit too much debt. So in that particular situation, your action plan could be to focus more on paying down your debts, right? So this is where every person is going to be slightly different depending on their financial position. But these are essentially the buckets that are needed that need to be fulfilled in order to be considered for a positive mortgage loan application. What's not taken into account is your race, ethnicity, or gender. So that's part of fair lending, and I just wanted to tie into that because in the mortgage loan application, you do fill out a section under the Home Mortgage Disclosure Act that asks those 3 things. Oftentimes, applicants just jump over it because, hey, the government doesn't really need to know my background, right? Well, essentially it's not for the borrower, it's actually for the lending institution that's lending the money. That's a way to measure the banks and the lending institutions that they're reaching out to different communities. So know that those questions under the Home Mortgage Disclosure Act do not play any role in the mortgage decision process. These questions simply assess whether or not the lending institution is able to reach different communities. So credit history, right? Why this is so important? Because oftentimes this is perhaps one of the bigger hurdles to homeownership. People may have good income, good savings, low debt, but our credit history may be something that could be hindering us, right? So know that although there are companies out there that promote services to improve your credit rating, I always kind of go back to this analogy of running a marathon, right? If I pay a company to sign me up to run a marathon and they put me at the starting line, but if I'm not fit, I'm not going to finish that race, right? So going back to managing my budgets, managing your income and expenses, that will prepare me to managing my obligations, which essentially is my credit, right? So timeliness of payments. Your score is reflected of the past 24 months performance. So anything you have current, you want to stay current on. Any late payments, well, if it happens, if you have any late payments within the past 24 months, those late payments have a heavier burden than late payments that you've had more than 2 years ago. So if you had a late payment, say you paid your car payment late in 2017, chances are that late payment is not going to affect your score. It'll still be part of your history, but that late payment is no longer affecting your score. Your score is reflected of the past 24 months performance. The cleaner it is, the better. But any late payments essentially are the further you're away from those late payments, once you reach that 24-month period, they're really not going to affect you. New inquiries do provide points off your score. It is important that if you are focusing on buying a home, that you limit very much your credit applications, whether they're for store credit cards, whether you want to sign up for a new cell phone contract. It's very important that you minimize any type of activity. Oftentimes, you may go to not to pick on any of the big stores, but you go to the store and they're offering you a 5 or 10% discount, right? Just sign here. That's a credit card application, and if you want that 10%, you're actually going to inquire. A new inquiry will be registered on your credit report. So that's a couple points off. So once again, limit as much inquiries as possible. Past credit problems. It's important to know what those past credit problems are. If you simply just, hey, you had some challenges in the past, you're moving forward now, those challenges eventually will fall off, just depending on what type of issue was. But unfortunately, the companies that provide services around credit rebuilding or credit repair, they've gotten a bad rap throughout the years. So not to say that they're good or bad, just know that unfortunately in the industry they've gotten a bad rap because of the fees they charged and not really helping clients. There are some good ones out there, but you also have the support of the Achievement Academy that can assist you with this as well. And we can validate the Achievement Academy all day long. So if you have, or if you feel that you would benefit from credit counseling and assisting you to navigate through credit, that's available through the Achievement Academy. Credit types and credit amounts, they kind of go hand in hand. Credit utilization, it's important that if you do have credit card balances, that those balances are paid down. The rule of thumb is to always keep your balances, your ongoing balances, below 30%. So quick example, if you have a credit card with a $1,000 limit, you really want to use that credit card at or below 30%, at or below 30%. So it's about $300. Why would someone give you a credit card for $1,000 and tell you only use $300? Well, it's once again, it's how credit is scored and it's managed. But the lower the balances, the better utilization. The good thing is that well, one of the easiest ways to increase your credit score is to simply pay down, not close off, but just pay down those balances. And it's okay if you don't have a balance. So let's just say that you pay that credit card off every month, or you simply don't use that credit card very often. That's okay, because even if you don't have a balance, that credit card is still being reported as an on-time payment to your timeliness of payments. So once again, these conversations, if you have questions, Achievement Academy can assist you. And of course, your account balances, once again, the lower they are, the better. Account balances reflect more of closed-end or term loans. So essentially, if you have a car loan, it's going to end, say, in 5 years. So obviously that's going to create the history, but the balance will decrease. And of course, once that balance is decreasing, your score will be reflected. This is just a quick overview of an application checklist. You would work with your mortgage loan professional in terms of what documentation would be needed for each category, such as employment and income, your assets, identification, liabilities, current housing expenses. This is where you would really have a one-on-one discussion, because there's a lot of documentation that is needed to submit your complete mortgage loan application. And oftentimes there are some online applications that can alleviate and expedite some of these documentation processes, especially disclosures, where you can actually sign that you've received the disclosures online. There's an application called DocuSign that tends to help the process speed up, but know that there's still items that you would need to collect if there's questions along the way. So just be prepared. Best advice here is, be organized during this process. Keep everything in a file folder, or just know where it's at, because you're going to provide this perhaps more than once to your mortgage loan application, to your mortgage loan professional. This screen here provides you just a quick overview of your monthly payment, your monthly housing payment, and why, going back to the affordability factor, why this is so important is that this takes into account your complete housing payment. So if I currently rent today, my rent payment is just one single payment that goes to the landlord for me to be able to live in that house. That's my housing payment if I rent. If I'm a homeowner, my housing payment has several layers, so it's slightly different. The first layer, or the first portion, it's my actual mortgage payment, which is my principal and interest payment. If my mortgage loan is a fixed rate mortgage, which I'll talk about in the next slide, if my mortgage is fixed, where the payment is constant, then my mortgage payment will not change throughout the life of the loan. What changes is the proportion of what goes towards the principal, which is the amount borrowed, and the proportion of the interest. So my mortgage payment truly goes towards my principal and interest. The different layers are part of my housing payment, but are not part of my mortgage. So for instance, my property taxes, I gotta pay property taxes twice a year. What the lender will require me to do is they're going to require that those property taxes be included in my housing payment if I don't put down more than 20% of that purchase price. So most of us that are purchasing a home will essentially pay our property taxes with our housing payment. So property taxes, you simply take the amount that you would be paying every 6 months and you divide it on a monthly portion, and that monthly portion is now part of your housing payment. Same thing with your homeowner's insurance. Your homeowner's insurance is paid once a year. The lender will require to manage this, and whatever that portion is, whatever that monthly portion is, they would include that as part of my housing payment. So this acronym called PITI is really referencing my principal and interest, which is my mortgage payment, my property taxes, and my homeowner's insurance. So essentially, that's my housing payment. Where there might be some fluctuations is depending on the type of financing that I obtain, I may have an extra layer of payment called private mortgage insurance. Private mortgage insurance is included with my mortgage payment if the mortgage loan program requires it. Typically, every FHA, which I'll talk about in a few minutes, every FHA program has PMI, and other programs that are not conventional programs may require private mortgage insurance. And I know I said conventional, I'll cover that in just a second, but essentially PMI is added whenever the loan or the lender finances more than 80% of the purchase price. So in that particular case, your housing payment would be including principal, interest, taxes and insurance, and your PMI payment. If the property happens to fall in a flood designated zone, then you would have to have this extra layer of insurance called flood insurance. Flood insurance, unfortunately, it's not cheap. And just because you are buying a house close to the beach doesn't mean that you're going to need flood insurance. It's mainly based on topography as how FEMA, the layouts provide when it rains, there might be some water overflowing. So this is information that you can ask your agent, right, when you're looking at houses that, hey, I really want to avoid flood insurance. So make sure that the properties that you're looking at are not within a flood designated zone. But in case if it was, you would be paying your principal, your interest, which is your mortgage, your taxes and insurance, PMI, and your flood insurance. So notice how that housing payment could expand depending on the circumstances. Homeowner association dues, any property that's attached, such as a condominium, a townhome, you would pay this additional HOA fee because the HOA covers the common areas and the structure of the attached property. So if you were to buy a condominium, you were using FHA, and that condominium happened to be inside a flood zone, then your housing payment would be principal, interest, mortgage, taxes and insurance, private mortgage insurance, flood insurance, and HOA. Not to scare you guys, I'm not here to, I'm not, obviously it sounds quite a bit, but know that knowing this, right, then you can prepare yourself to say, hey, now knowing that there could be these extra layers of payment, how can I avoid these extra layers of payment, right? Down payment programs could be one of them, right? Also, avoiding properties that could have flood insurance, that may be another one, or programs that simply do not have private mortgage insurance, right? So the last thing I want to add here, not to scare you as well, but new communities here in Chula Vista, where I'm from, we have communities that have Mello-Roos. Mello-Roos are fixed assessments that are generated through bonds, which create the infrastructure built of schools, sidewalks, streets, parks. So essentially those bonds are passed on to the homeowners in those specific communities. These fixed assessments have a specific time period, such as 15, 20, 25, 30, 35, 40, 45 years, and there are part of your property tax payments. So really quick, if you're buying a townhome in a community that has Mello-Roos, and it happens to be inside a flood zone, and you happen to be using FHA, your complete housing payment would be your principal interest, which is your mortgage, your taxes and insurance, your private mortgage insurance, your flood insurance, your HOA, and your Mello-Roos. Not scaring you guys, now you know, right? So when you're in this process, you might be able to say, hey, I want to avoid private mortgage insurance, I want to avoid flood insurance. Hey, I'm okay buying a condo. Once again, every person is going to have slightly different variations of what they decide, right? But now you have the knowledge, now you know, and the resources to make those decisions, right? So this is also part of your affordability, and how I like to explain housing ratios is essentially every program has a specific ratio that program allows. So just to give you an example, if my monthly income was $4,000, if that's my monthly gross income, $4,000, and my housing payment, right, PITI plus those extra layers, was $2,000, that would mean that 50% of my income is tied to my housing payment. My housing payment is related to my front end ratio. 50%. Would you say that's high? Would you say that's low? That's pretty high. If 50% of my income is tied to my housing payment, right? And my housing payment, once again, is what we just went over. So essentially, that would put me in a very unique situation, right? If there was if I called in sick one day at work, is that going to hinder me for me to be able to pay my housing payment, right? So a housing ratio, every program has specific housing ratio. The lower the housing ratio, the more affordable. The higher the housing ratio, the less affordable. And this is where, once again, different people are going to have different decisions. Perhaps one person's okay to have a higher housing ratio than someone else. And only those particular households will decide what's best for them, right? The back end ratio or the total ratio takes into account my housing ratio, my housing payment, and my monthly obligations. So going back to my example, if I make $4,000 a month and my housing payment is $2,000 a month, then my housing ratio is 50%. If I have a car payment, 3 credit cards, 2 student loans, those are part of my obligations. Those obligations plus my housing payment are then compared to my income. So if my back-end ratio is at 65%, gosh, that's a very fragile financial picture, because I literally will not have a whole lot left for my living expenses, right? So this is where sitting down with a housing counselor, going over your budget, right? Understanding what obligations you can minimize. Perhaps you have things here that you can pay off. Perhaps you're okay selling off that newer car and maybe buying a used car just to lower your overall obligations, so you can put yourself in a much better position in the housing ratio. Every program has specific ratios, by the way. I think I mentioned that, but the higher the ratios, the higher the risk. So steps in the mortgage process. I know we're coming up towards the end of our hour, and I want to allow time for Q&A. So the steps in the mortgage process, I'll just kind of just glance right over, right? You know, you would submit a complete package once you find a property. So before you find a property, you're still in this pre-approval stage, right? Where the lender simply verified 3 things. Once your offer is accepted, once you make an offer to purchase a house and that offer is accepted, that's when technically your mortgage loan applications begins. And we went over that checklist earlier, right? So there's a lot of documentation that's involved. But just know that there's several steps along the way that verifies that information before it goes to that final approval process. So understanding just a little bit of facts about your mortgage, right? The larger the down payment, the less the mortgage payment, right? Pretty obvious there. A loan with less than 20% down may require private mortgage insurance. There are some great programs out there that do not have private mortgage insurance, even with a down payment of 3% or 5%. So just know that there are programs out there that do not have private mortgage insurance. Your home serves as collateral until the mortgage is paid off, right? So your home is backing that mortgage payment. The interest rate, along with the term and the amount of the loan, determines your monthly principal and interest payment. So these are just some of the terms associated with the loan, and I'm trying to allow us time for Q&A. So I'm just going to skip some of these terms. Types of mortgages, not just offered by Citi, but in general. Fixed rate mortgage, that simply means that the rate does not change for the life of the loan. The rate stays constant for the life of the loan. The loan can be a 10, 15, 20, 25, or 30-year mortgage. A fixed rate interest rate, an adjustable rate mortgage, starts out as a fixed rate mortgage, then it adjusts. It can adjust at year 5, 7, 10. So it basically looks and smells just like a fixed rate mortgage, but after that initial fixed period, the interest rate can go up or the interest rate can go down. FHA is a program that provides flexibility in qualification criteria. HUD or FHA is not lending the money. They're simply providing the guidelines for this program. And the FHA program requires only 3.5% down, and the rest is financed under one loan. FHA has private mortgage insurance for the life of the loan. So it's not a bad program, but just understand how it works. The VA program, the Department of Veterans Affairs, perhaps one of the best programs out there for qualified veterans of the U.S. Armed Forces and their spouses. It's a program that finances 100% of the purchase price. Phenomenal program, phenomenal program. It has no private mortgage insurance. So if you are a veteran of the U.S. Armed Forces, first of all, thank you for serving, but this is perhaps one of the better programs out there that you have access to. So with that, guys, I think I'll stop here. I can mention some of our programs through the Q&A, but I want to allow us enough time to have our Q&A session. So Juanita, I know there might have been some questions in the chat box.
There's a number of questions. I've been keeping track. So we can start out with the first one, which is, what is an amount you need to have in the bank when you start looking for a home?
Very good question. Very good question. So it's not a I mean, there's not a right or wrong answer to this. Obviously, the more stable, the higher the amount, the more stable the applicant looks. But a good rule of thumb is 2 to 3%, 2 to 3% of whatever you're buying. So if you're buying something at $300,000, you're probably looking at about $9,000 in savings. A 401k plan can also be considered as part of your assets. So here's the thing, you may not need the complete 3%, but initially you need it to be eligible for certain programs. So that's the thing. This is where speaking to a housing counselor or a mortgage loan professional, depending on your situation, they can provide you with options. of your options right now and your options moving forward.
So the next one is explain supplemental taxes, please.
Very good question. Supplemental taxes, when you purchase a home, oftentimes there's a lag between the, the current assessed value and the new assessed value. So the current assessed value is based on the homeowner now. The homeowner could have purchased the property, say, for $200,000 10 years ago. You come in, you purchase the property at $400,000. Your tax assessment will be based on $400,000. You're not going to be paying the assessment from the previous homeowner. So from here, from the previous homeowner to you, that's where there's a lag in adjustments. So the supplemental tax, which is a one-time bill, you pay it after you purchase the home. Depending on the previous tax assessment and your current tax assessment, which is where you purchase the property, that's where the assessment is made.
Perfect. So the next question is, what is approximate amount of fees that you can range in with closing costs?
Very good question. 2 to 3%. 2 to 3% of the loan amount is where you would have more or less where the fees may fall. Depending on the lender, some lenders may charge you a little bit more, some lenders may charge you a little bit less. Know that there are programs out there, such as closing cost assistance programs, whether through a city or a nonprofit, or even some of the lenders, some of the big banks offer closing cost assistance that can lower that amount. But typically is anywhere from 2 to 3% of the loan amount.
So then the other question that I see here is, if you combine mortgage with homeowner's insurance, does that incur interest, or is it just a one-time payment?
Very good question.
Payment?
Very good question. So the homeowner's insurance is paid every year. So the bank will collect like 2 to 3 months in advance. They put that in what's called an escrow account, like a savings account. So when your bill comes due, they simply take the money from this account to pay your bill. Every year, there's an account analysis that's done on your escrow account. If there's too much money, they send money back to you. If there's very little money, very little reserves, then they may ask for an additional payment to have in your reserves. But this is your money. So if you ever sell the house or refinance, this money goes to you. It doesn't go to the insurance or the tax assessor.
Next one, can you explain how much the PMI will be a month for, say, a $500 home, and how long do you have to pay it? I think you answered the how long you have to pay it.
So if it's an FHA, it's for the life of the loan. An FHA always will have private mortgage insurance unless they change the guidelines down the road. But today, it's for the life of the loan. Other programs, you can actually request the PMI to fall off, or to be removed, I should say, once you create this cushion. And what this cushion is when you start off, your loan amount starts here and your property value starts here. So once your loan amount starts to be reduced, and once that amount of reduction reaches that 80% or there's enough cushion in there, that's when you can request to remove the private mortgage insurance portion. So on an FHA loan, just to give an idea, on a $500,000 loan amount, the private mortgage insurance is about $354,000. That's an 85% assess tier level for that PMI. FHA tends to charge a little bit higher private mortgage insurance. There's other programs that are charged a little bit lower. So I hope I answered that. It's around $350 for a $500,000 loan amount under FHA. Your private mortgage insurance will be about $350.
Perfect. So isn't principal and mortgage considered the mortgage only?
Absolutely, yes. Yeah, the P&I, principal and interest, that's only your mortgage payment. Correct.
Perfect. Explain what escrow is. The term going into escrow.
Perfect. So that's a term that's utilized by practitioners, real estate practitioners, that when we go into escrow, we start escrow, we're opening escrow, we're in escrow, means that you are in an active purchase contract. My offer has been accepted by the seller of the property. That's when we go to escrow. And escrow is that third neutral company that's between you as the buyer and the seller portion, or the seller entity of the transaction.
Perfect. So here's another one. It says, if you want to take advantage of the programs available through the San Diego Housing Commission, do we have to use a specific bank? I'm currently with a credit union, a local credit union.
Very good question. The San Diego Housing Commission has great resources on their website. They have a lender partner list that's approved. Any person, any lending institution on that lender partner list is approved for the programs under the under the San Diego Housing Commission. So no, you don't have to go to a specific lender or institution if you want to use the San Diego Housing Commission programs. You can, if you want to use the San Diego Housing Commission programs, you can choose from their list of approved lenders. Some credit unions may not be part of the program, but I would also encourage you to talk to your credit union, because oftentimes credit unions have very good programs for their members. So compare the two options.
Yeah, so we have something here saying, since I can't go to the office because of COVID, how can I connect with someone to start the home buying process?
Oh, absolutely. Most lenders, I would say about 99.9, are virtual, have access to virtual applications, meaning they can jump on a Zoom call, obviously over the phone. You can always access the San Diego Housing Commission's website and pull all the resources from online as well. So there are some lenders that can also, and I guess this part, I can only speak on behalf of Citi. Our lenders do have access to our branches. It's by appointment only. So let's just say that you wanted to speak to a loan officer, you would have to make an appointment, beforehand, so we can kind of go through the safety protocols. I can only assume other banks and institutions are following that same format, where before a lender can say, yeah, come today at 3 o'clock, I'm available. Now they're saying, why don't we meet on Friday at 3 o'clock? Because I would have to reserve space inside the branch. Branches are very limited, right? You can only have about 10 people inside the branch. So you kind of reserve your space and your time. And of course, with the safety protocols. So if you do want to see someone in person, I can only assume that most lending institutions have followed certain safety procedures to allow for that. But it just takes a little bit more planning to be able to see someone in person.
So we have one with a three-parter. So the three-parter is, right now with what's going on, do you recommend buying? What do you think will happen when the moratorium or rent ends? And will it be better to wait to buy?
Very good question. So the first question is it a good time to buy today? Regardless of our COVID-19 environment, this question is always a question that's asked in home buying workshops, and very rightfully so. My question has, I guess my answer has always been the same answer that I had as a housing counselor. And that is, it's the right time when you're ready. Here's the thing. You may have heard that rates are phenomenally historically low today. So from that perspective, yeah, if you were to get a loan today, you're getting it at a historically low interest rate. However, inventory is extremely limited. So potentially you may or may not find the exact property that matches what your needs are. So once again, one person may decide, it is the right time for me because out of my 5 priorities, this property matches 3 of them. So I'm okay with that. Another person would say, no, it has to fulfill these last two priorities because these are extremely important to me and my family. So potentially this person, it may not be the right time to buy. So it always goes back to not just the financial picture, but also in this particular case, the external factors, such as where are you in your career, in your employment, in family life, in housing counseling, oftentimes families that were transitioning, right, out of their homes, there was a lot of questions about their housing. So in that particular situation, buying a home may not be the right time. Other families were joining, right? Hey, we're going to join, households. Is it the right time to buy? So all those different factors. Once again, I set priorities, set goals, and if they're matching, then potentially it's the right time for you. But if they're not matching, such as, hey, I may be getting a job I live in San Diego, I may be working in Riverside. Are you okay with that commute, right? So once again, it just match your financial and personal priorities. And if they're lining up, then yes, it's a very good time to buy. And if they're not lining up, then reassess because it may not be the right time to buy.
Perfect. So here's the thing. We've got so many questions coming in, Sergio, and what I'm going to do is easily just say to everyone who's asking, how do you get started? Reach out to me after the workshop, and then we'll see where you are with your credit, where you are with your savings, where you are with all of that. Please bear in mind that if you're asking to meet with me and all of you come at me at once, it's going to be a little hard for me to reach out to everybody at one time. But I will reach out, I will connect with everyone and help out as many as I can. The next question, Sergio, is grants for first-time home buyers.
Yes.
If we have unnecessary credit cards open, is it optimal to close them all at once? Unsure how much to keep open to build credit.
Oh, fantastic. So if you currently have credit cards open, and if you are considering to apply for a mortgage, you do not want to close off those credit cards. Even if they have a zero balance, keep them open, because even with a zero balance, those credit cards will still report to the credit bureaus an on-time payment. So this applies for someone, right, that is managing their current obligations. If I'm not able to manage my current obligations, meaning that I'm barely surviving with the minimum payments and every single credit card is maxed out, then that's a separate conversation. But for someone that's able to manage their obligations, they can keep their balances at or below 30% or even pay them off, continue keeping those accounts open, because they will continue to be reporting as an on-time payment. The fact that you don't have a balance is not going to hinder you in the mortgage application. I'm sorry, what was the second question? Sorry about that.
They weren't sure what to keep open, but at this point you've answered the question.
Okay.
And then the other one is, what do you provide? 401k information or trust account information to banks? I would say all assets.
Right. Any type of asset documentation that you have, you're not going to, just because you have a 401k, the recommendation is not going to be, yeah, pull the money out. No, it's one thing, it's your financial picture. In certain situations, it makes sense to use the leveraging tool of your 401k, perhaps for your down payment, in certain situations. In certain situations, it just serves as a compensating factor. Hey, this person has a substantial amount of funds in their 401k plan. We're not touching them. Good. It just serves as a compensating factor.
So this one is interesting. It says, if I get approved right now and they give me an approval for a lower amount and I need to be approved for more than that, when do I redo my approval?
So if you get it pre-approved right now, and I'm just going to throw some numbers out here. If you get pre-approved for $300,000 and you want to buy a bigger house at $400,000, then the first question is affordability. just right off the bat, what's my affordability? Because a $300,000 mortgage payment, housing payment with taxes and insurance is a lot less than obviously than a $400,000 housing payment. So I really need to understand what's my affordability. Second, what's keeping me from having that higher loan amount? I may have other obligations that I'm carrying along, such as a car payment, such as 2 car payments, such as 3 credit cards, such as student loan payments, such as child support, back taxes. So if that's what's keeping me from having a higher loan balance, then technically the focus isn't really the mortgage. The focus is now my obligations and how to reduce those obligations so that I can maximize my purchasing power, my affordability, and my purchasing capacity. So those would be like my immediate questions. And then lastly, yeah, there is down payment assistance that is available. Find out if once you're eligible, right? Because down payment assistance is based on income criteria, is based on household size, is based on geographic location. So I would consider if that's an avenue that I want to pursue. And if not, then I kind of go back to my original answer, right? Look at what's hindering me from having that higher loan amount.
Okay, so since we're gone over, I'm trying to condense some of these. So there's a bunch of them asking about interest rates and student loan, how they affect the purchase power, and grants that are out there. And I guess we could say that it all depends on your credit score.
Right. So here, what's the interest rate to buy a house today? So right now, you may have heard the saying, right? Historically low interest rates. And we've heard that before because it seems like every quarter they're historically low. They're historically low. They're historically low. I mean, right now, yes, they are historically low. The thing about knowing about interest rates is that to someone to quote you a rate, they need a couple of more. Actually, they need a lot more things for them to quote you an actual rate. A loan application, the type of house, how much down payment you have, loan to value ratios, debt to income ratios, the type of financing that you're using. So yes, they're historically low. You can Google just 30-year fixed mortgage and you can get a really good idea of where the rates are. But let me tell you this, kind of like let's just say that the rate today was at 1%. Fixed for 30 years. Fantastic. If we're not in a position to buy a home, if we don't have an offer accepted, that 1% isn't really going to help us. It's when you actually are in escrow that you begin to really look and pay attention to the rates, because eventually you're going to have to lock in the rate, which would be the rate for the life of your loan. So yeah, gauge where they're at, Google them every day. But know that rates are fluctuating, and just in general, right? In November we have a big election. In my experience as a loan originator and just in general a practitioner, typically rates tend to stay the same up and even after the election. So just and this is once again, this is my observation going back to the last 5 or 6 elections, that interest rates during the election year tend to just kind of stay where they're at. There's not a whole lot of shaking until afterwards.
Yeah, and then they're asking for your contact information if they have future guidance, but I've asked them to reach out to me first.
Yeah. Go through Juanita and go through the San Diego Housing Commission. By all means, yeah, and then yeah, definitely.
Okay. Well, it looks like that's the end of the questions, Sergio.
Fantastic.
I think we're in a good place now. I mean, you really marathon those questions. There was a lot of them. Thank you.
No worries. Happy to be here. And I see. No, go ahead.
I wanted to just say that me and you are working on a program, an eight series workshop for everyone. We want you all to know that those are coming up too. That'll be the requirements or information on every single step to home purchase. Those are coming up probably later on in the near future. Well, me and Sergio get all that taken care of. Right, Sergio?
Absolutely, absolutely. We'll have more guest speakers, so it's not going to just be me the whole time. So we'll change it up a bit.
Very, very informative. They're saying thank you for the meeting. They're really appreciative. This was really great. You did a really good job, Sergio.
Thank you.
Just as an FYI, everybody, we're having in the month of September 9 financial workshops on helping you build your credit scores, helping you with anything that has to do with your financial portfolio and how to get it better. They're going to be every Tuesday and Thursday. So you may want to come into those to try to start working on getting your scores where they need to be if they're not there yet. Okay. And I think at this point, Sergio, if there's no other questions, I do have a couple. I have somebody with an iPhone and somebody named Mohammed. I don't know who you are, so I can't give you credit for this workshop. So unfortunately, if you didn't give me your name, I will not be able to give you credit for the workshop. If any other questions arise, please feel free to email me and I will go ahead and do my best to reply, to provide that for you. Okay. Bye, everyone.
Thank you.
Bye, Sergio.